Recording in progress.
And hi everyone, this is Finance Meets Real Estate. We have Pancham Gupta here today, so is his partner Rajan. And so they're the co-founders of Untitled Capital. They have, I think, currently 100 million assets under management as real estate syndicators. Pancham is also the host of the Go the Core podcast. And yeah, so maybe let me see let me see some more info that I got, but pretty much that is like the most important summary, so because it's a real pleasure to have them here, and I believe Rajan will be joining us in a minute, and yeah, they've done a lot of business in the real estate space, so maybe Pancham,
Yeah.
not too good.
Sure. Thank you, Stefan, for having us, both me and Rajan. He should be joining us any second. We both have been, in real estate syndication space for 5 years now. We both are full time. And today, what we are going to discuss, the topic of discussion today is what is the difference between single asset syndication versus a fund? Like, what's the difference? And Stefan, just feel free to chime in anytime. Like if you want me to go over what syndications are, also we can briefly touch on that as well.
Absolutely, and just to interject, Pancham, I just wanted to say, like, if you guys have any questions, feel free to put them on the chat during the lecture, and we're gonna open up for Q&A at the end.
Got it. Okay, cool. So yeah, I let me get started here. So we before I get to the presentation, the details, and the content, this is just for the informational purposes. We both, me and Rajan, we both are not attorneys. Please consult your legal team before making any decision. Just a quick disclaimer there. So, all right. So here's the agenda for today. I will go over the brief introduction on me and Rajan. Then we'll discuss what is a single property syndication, and then we'll go into what is a fund. Then finally, we'll discuss the pros and cons of a single asset syndication, pros and cons of a fund, and then we will go into an example of a fund. Like what is a tip one? We have one fund. What does a fund look like, right? And then finally, the $1 million question: which one is better? Is it a fund or a single asset? So we'll try to answer that question as well. And finally, we'll take questions from the audience on anything that we share today. All right, so let's get to the introduction. This is me, founder and principal at Misos Capital, full-time multifamily syndicator with $100 million in under management. I graduated from Carnegie Mellon University, spent 14 years in fintech industry in New York City. I'm an equity partner in 600 plus units in self-storage, multifamily, and resort properties, invested in over 5 different states and internationally. Like Stefan said, I also host a Gold Collar Investor podcast, where I actually spend all my time in teaching high-paid professionals on investing, diversifying outside of Wall Street, learning about personal finance, things like asset protection and life insurance, and different kinds of asset classes. So that's the podcast, and I also run a multifamily mastermind here in New York City. Which actually I have to admit, after COVID, we don't meet as much as we were doing before COVID. So that's Rajan. I don't know if he's on already. Rajan, are you on?
I'm here.
Okay, yeah, go ahead.
Hey guys. Yeah, so a little bit of myself. I'm a founder and principals at Misos. I manage a portfolio of multifamily mainly and some commercial real estate, totaling over 800 units now. We control 100 million primarily in New Jersey, Florida, and North Carolina. Looking at the financial analysis, asset management, and operations side in our business. So far, we have a good track record of value add, rehab, and stabilization of multifamily properties, delivering like double-digit IRRs to our investors. My educational background also includes a bachelor's and master's in computer science.
Thanks, Rajan. All right, so let's get into a single asset syndication. So, what is a single asset syndication? Syndication in general is nothing but a project that you do after bringing together a team, and you can syndicate anything. If you, for example, let's say we were in a room today, and Stefan actually ordered food for everyone, and he charged $5 for the food. He just syndicated the food, right? So that's a very simple example of a syndication. But in the real estate sense, what that really means is that you have you pool bunch of resources, in this case the capital, and you go out and do a project. And we have limited partners as syndicators, limited partners who are the investors, and then we have general partners who are the pilot of the plane, so to speak. And they actually run the entire project. The investors invest in the capabilities of the syndicators and the actual project, so that they can have their money grow and get all the benefits that they think they will get from that particular investment. So that's a single asset syndication. You have to register with, SEC to get, you have to file an exemption, Reg D exemption with SEC to actually legally raise this capital. And so that's a very brief definition of what a syndication is. Now, what is a single asset syndication? For a single asset syndication, here is the steps that you have to take in order to actually do a single asset syndication. So me and Rajan, for example, we are syndicators. What we will have to do if we are doing a single asset syndication, we will first go out and find a deal, right? We'll see, okay, this particular deal, after looking at many deals, let's say we find one which makes sense. And once we find the deal, we like it, we do our numbers, it meets our goals, our investment goals, and then we will submit something called an LOI, which is the letter of intent, to the broker, if there is one in the middle. And basically it's like an intent to buy the property with all the terms listed. Then let's say the seller accepts the offer. There will be attorneys involved, and there will be a contract, a purchase and sales agreement, right? That would be created and signed. And once that is signed, then we do something called DD, which is the due diligence on the property. We go out there, we inspect the property, we check the roofs, the outside, the interiors, all that stuff. And we look at the financials, the contracts, anything that has to do with the operations of the property, right? So that's due diligence. Now, once the due diligence is done, now at that point, we release the deal to the investors. That's when the capital raise happens. So we, at that point, already know where the property is located. We already know how many units the property is. We already know that, this is how much money it would take to actually fix up the property. If it needs the new roof, we would know that. If it needs new parking lot, we would know that. How many units have to be upgraded, we would know that. All of that is known by the time we actually release the deal. So when investors get the package, they already know where they're investing, right? They already know where the deal is. They already know what the numbers look like. They already know what the business plan is. And once that's done, once the the deal is released and the capital is raised, we create something called a single purpose LLC, right? So if let's say we're buying ABC apartments, we will create ABC Apartment LLC, right? That will take the title to that particular apartment complex. And then once that is there, we will create something called deal specific, all of this is happening at the same time. I shouldn't say that. So single purpose LLC, deal specific PM, and the releasing of the deal, they happened they happen in parallel around the same time. So what PPM means here is the private placement memorandum. That would have all the risks that is associated with the deal, everything around that deal, all the details, all the fees, the IRRs, everything will be mentioned in that PPM. We will release it to the investors so that they can sign. Investors come in and we close the deal. So those are the steps that are followed for a single asset syndication, right? So that's that. We already know what the property is, where it is, and all that. Now, what is a fund, right? In case of a fund, there is, like, we don't have a property. You don't know where that property is. You actually have an objective. For example, let's say you want to create a fund, and you can create a fund for anything, any asset class. Let's say you are into movies. All of your investors are into movies. They love movies, specifically James Bond movies, okay, and Tom Cruise Mission Impossible movies, right? So you and your investors are like, you know what, we want to invest in Tom Cruise Mission Impossible, and we want to invest in James Bond 007 movies. So why don't we raise capital and pool the money together, and we will be the producers of these movies? So let's create a fund, and the objective of the fund would be to invest in only Tom Cruise Mission Impossible series and 007 James Bond movies. Okay, that's the objective. Movie hasn't been made yet. There is just an objective that it will be investing in the movies where Tom Cruise is the lead role, and or the James Bond, right? So that's an objective. The actual thing doesn't exist. It's just an objective, right? So now taking that example into a multifamily, you can have an objective like, hey, we are going to be investing in Jacksonville, Florida, Tampa, Florida, and Raleigh, North Carolina, Charlotte, North Carolina. These are the markets, and within these markets we will be investing in the properties which are 100 or more units, and they're built after 1985, and they have no chiller system on them. They have to have PVC plumbing. They cannot have cast iron pipes, and so on and so forth. There could be a lot of long list of things that you can have, and then it can also have objective related to the returns. It has to meet at least 7% cash on cash return. It has to have at least 13% IRR, right? All those are objectives. Again, property doesn't exist. You only have the objective, right? So it's also called a blind fund. And a fund, just like it can have multiple movies, it can invest in same thing. You can have multiple assets where you can invest in. And the PPM, which is the private placement memorandum, as opposed to a single asset fund where it was very, very specific to the property, right? In case of a fund, it is very objective based because the property does not exist right now, right? So that's another difference. And then the emphasis in case of a fund is really on the manager. Like, how is the manager going to do versus the deal, right? You have to have that confidence in the capabilities of the manager that whatever the objective of the fund is, they will be able to meet that objective. Okay, so emphasis is on the manager, and returns and the fees is a guideline. Okay, if it hit at certain number, this would be the return, or if this is and this is the fees structure. So that's really what the difference between a fund and a single asset. So let's talk about what is a pros and cons of a single asset syndication, right? So pro is, exactly as an investor what you are investing in. You know the numbers, you know the location, you know the quality of the asset, like all the little details, etc. So, like number of units and all that, right? And numbers are very easy to review because you only are talking about one asset, and that's the only asset that you're reviewing, right? On the other hand, the cons are that there is no diversification, right? You are invested in this one asset. If the project does amazing, you are going to do amazing. If the project does average, you are going to do average. And the project bombs, you potentially lose your capital, right? So that's that. And then you also cannot really time the market, right? So let me explain that a little bit. For example, let's say you have a deal and you really like it, and you only have $50,000 to invest. Okay, so in December, you get this one deal from one of the sponsors, and you really like it at the time, and you invest your 50,000. Now 6 months go by, uh, you have another deal that comes up, and the market has softened a little bit. Market has gone down. Now this new deal that you see is screaming at you. It's an amazing deal. You know that you live in that market. You know it's an amazing opportunity, but you can't invest because you invested in that 50,000, that all you had in that one deal. But instead, if you had invested in a fund could buy that deal. Now your 50,000 at that time is diversified across these two properties. So you cannot really time the market when you're investing in the single asset syndication. So hope that makes sense. And now let's talk about pros and cons of the fund. You get the diversification. You get diversification across asset classes. You could have a fund which is invested in multifamily and self storage and mobile home parks, different kinds of asset classes. You have different geographies, right? You are invested in North Carolina and South Carolina or Florida, whatever gels with you, what you think is going to grow. And then you get strategy level diversification as well. So let me try to explain this a little bit. That you have this fund, and let's say it's doing amazing, right? 95% of that fund is invested in these properties, and they are doing amazingly well. And the sponsor decides, of course, that 5% of the capital he really wants to invest in Raleigh, North Carolina, because Apple just announced a campus there. He wants to buy land next to Apple's campus so that he knows that at some point that's going to get developed, or he will develop it, and they're going to go for the moonshot. Okay. That's a strategy. Of course, the fund objective has to allow for it within the means of the objective, but there is a diversification across strategy there, that they are trying to diversify. So that's strategy. And then timing is what we just discussed as a con for a single asset. Now your money is invested in multiple deals across different time horizon. All right. So, and also one of the pros is that if you invest in 10 different assets, you're going to get 10 different reports, okay, as a monthly reports, versus if you invest in a fund which is invested in 10 assets, you get one report. It's very simple reporting when it comes to fund. And the distributions are very, very smooth, because you could have 5 blockbuster deals, 4 average deals, and one really bad deal out of 10 deals, and you would still your distributions would be much more smoother. The cons on the other side is, you as an investor have very limited ability to underwrite the deals, right? Because you don't really know at the time the fund is created, other than the objective and knowing the manager, what you're going to do, right? Like, what is this fund going to do and what kind of properties? You just know the objective. You're trusting the manager a lot that they are going to follow suit to the ppm. So that's about the differences between single asset versus a fund, and the pros and cons. Now what we are going to do, me and Rajan at Misos Capital, we actually created a fund called Misos Income Fund, and you can actually go, as the name suggests, to the misosincomefund.com. You will have to register there if you want to find more details, but we'll go over the details here of the fund, so that we bring whatever I discussed home as an example. So Rajan is going to take it up from there. Rajan, go ahead.
Thank you. Uh, so just a summary of the fund. The fund is like a pref equity fund, creating a steady cash flow to accredited investors, high net worth, high income. And the goal is to protect the return and the preservation of capital. We'll go over in the structuring of the fund in the future slides. Like Pancham said, the fund seeks diversification. It goes into multiple projects across multiple markets. One of the design principles of the fund is that it's going to go only in a senior position to common equity, like a preferred equity sitting behind the lender. So basically, risk is minimized. And of course, because you're sitting in a preferred equity position, volatility is reduced as compared to stock market or other single family or small rentals. These are the asset classes the fund intends to go. Value add multifamily real estate is something that we do at Mesos. So the fund has taken position in two of the deals we have right now. It's going to take position in another deal we are going to be raising sometime later August. Single family and small multifamily preferred positions. We haven't done this far, but that's something the fund could do. Mobile home parks, self storage facilities, residential assisted living facilities, and medical offices. One key or one generic feature you see across these asset classes is they cash flow decently. So the main objective of the fund is to generate a good steady cash flow, and the upside is not there, as we'll go in the future slides, but it protects your capital while giving you some decent cash flow. A general criteria of the asset type we chase in the multifamily space: anything built over 1980s in the growth markets, 75 plus units, stabilized, 90% occupied, and not a lot of deferred maintenance. Market types, which is population and job growth, job diversity, the demographics of those jobs, and growing infrastructure. Currently, we are chasing the markets of the Carolinas, primarily Charlotte, Raleigh, Wilmington, Columbia, Charleston in South Carolina, and then North Florida. We are also looking at a couple of assets off late in the Northeast, given those things are like available at a significant discount as compared to some of the growing markets. So the ratio of the price to the rent that you're paying are looking very attractive there as well. Specifics on the fund: we limited the fund size to be 10 million. Minimum is 50,000. Again, this is open only to accredited investors. The fund pays a 8% preferred return and has a 50-50 split at the fund termination. And we are not charging any fee in the fund. So the fund goes in as a preferred equity position in our deals and can potentially go in other people's deal. And any fee or any splits that are to be paid are paid in the deal. Cash flow from operations, very simple. The payments start as soon as you go in and the deal closes. It pays 8% preferred. The payments in the income fund are made monthly, and anything you miss is obviously accrued. At fund termination, we are the plan is to wrap up the fund in about 5 to 7 years. If investors hang on to the fund till the termination, the cash flow from the fund termination looks like any missed or accrued preferred would be paid to the LPs first. All the capital will be returned to the LPs. GPs catch up because all our funds are 70-30 for all the money that the LPs have made over the years. The GP will do a catch up to make the return 70-30. And if there is any capital return left, we split it 50-50 between the GPs and the LPs. More detail, like Pancham said, go to mesosincomefund.com. You can sign up and subscribe. This presentation is available there. The PPM is available. It will give you a very good understanding of how to structure this fund. If at all, like, you can reach us also.
Rajan, sorry, just to interject. So question, so where you mentioned the 70-30 and then the 50-50, so is that in the case the fund potentially investing in not just your own deals, but also other sponsors' deals and having kind of a double waterfall in that case, or not?
No, so basically the way the fund usually goes in our deals, we pay a 8 to 9% pref to our class A or pref equity guys. So the fund goes in there, makes 8 or 9% and passes that to the investors. But potentially the fund could take a position in a better deal or in a more cash flowing or a yield play like a mobile home park or something, and the cash flow can be more than 8 or 9%. In that case, we return 8% to the investors during the course of the deal, and then when the fund wraps up, the fund returns are always 70-30 in all our funds, which means like any return, the LPs make 70%, the GPs make 30%. Because the LPs have made that 8% over like X number of years, and the GPs did not make anything, the GPs make something to make the return 70-30. If after that anything is left over, that is done 50-50. So basically the design of the fund is, hey, you're going to get all your capital back, plus you're going to make 8% for whatever time you were invested, and then the GPs start making money. So first the GPs catch up on that on the 8% pref that was paid, and if anything left over, then it will be 50-50. So what we are
Just
telling to all our investors.
again, so because I understand like the standard kind of waterfall 70-30 over 8% pref, right? But what is the 70-30 and 50-50 in this case?
So basically, the 70-30 is not over the pref. It is during the
Yeah.
pref also, but it gets paid on the back end. It gets paid only when the deals or when the fund closes. So if, for example, let's say the fund had $1 million, and it was only for 1 year. The fund made $140,000. I'm just cooking up hypothetical numbers. The investors will get $80,000. That's their 8%. And let's say the fund closes after year one. Because the investors got 80, the GPs will get like a 30, which is like about $34,000 to make it 70-30. After that, there is still $36,000 left in the fund returns. The GPs and LPs do 50-50 on that.
Okay. Yeah.
So what we are selling to our investors is, do not look at the upside or anything. Just assume you're going to get 8% in this fund, because that's what we are chasing. We are chasing, the goal of the fund is not to get into upside. The goal of the fund is to take a pref equity position, protect the capital, and make 8 or 9% stable.
Yeah, so the risk of capital loss on this is very very low, and so that's what the low risk, but there is less upside because of that, or
So,
no upside. Yeah.
so in this case, like engaging kind of that risk, like, is it invested in, let's say, core properties? Like, is it also in the sense of the selection of within multifamily, let's say, in
No,
the
no. So is your question that how is it less risky?
yeah. I mean,
Yeah.
yeah.
So the way it's less risky is that this particular fund takes in the pref equity position, meaning that after the senior debt is, after we pay the mortgage company their mortgage payment every month, first this fund investors will get their cash, and then the common equity investors get their cash. So the
Yeah.
capital stack looks like we have senior debt, we have very small slice of pref equity, and then we have common equity.
Yep.
Okay,
Okay.
so they get their money first, and then the common equity guys get their money. So usually this pref equity tranche is very very small, like 15% or so. Because of that, the overall common equity tranche is 85%. The chances of this 15% to not get their 8% is extremely low. There has to be some catastrophic event that has to happen where the property cash flow goes down by almost 80% or so for this 15% to lose money.
Yeah, as well
Yeah.
as on the back end. So for
And
example,
Yeah.
let's say a capital stack looks, is a $20 million deal. So the lender comes in at like about, let's say 15. Your equity raise is about 6.5, 7, includes your rehab, capex, everything. So from the 7 million, this fund will not take a position of over like 1.4 million. So when the deal unfolds, the common equity guy has to lose 5.6 million before the fund loses the first dollar. So the fund has a very big cushion that the value of the investment has to go down by 5.6 million on a $20 million investment, then the fund starts losing money. So it's not that you cannot lose money in this fund. Of course, if your property loses 40% value, you can, but the chances of that happening are very, very minimal. Similarly, like Pancham said, if the equity stack is about 7 million and you are projecting a 7% cash flow, you basically are underwriting that you'll make about $490,000 a year. And the pref equity guy, this fund takes about 1.4 million tranche at 8%. That's about like 112,000. So your cash flows have to go from 490 to 112 for these guys to not get paid their pref. So they are leaving their upside, but in lieu of that, their capital is very safe and their cash flows are very safe also.
And just to confirm, Rajan, so it's preferred equity in your own deals only, right? So you kind of carve out a pref piece within your own, otherwise syndicated deals, and you kind of put it into a separate fund and kind of with a different risk profile, obviously being preferred rather than common.
So far, so that's a no-no. The fund cannot take a common equity position. So far, we have only invested in our deals where we carve out this pref equity. We have looked at a couple of sponsors into asset classes that we don't do ourselves, like mobile home parks, self-storage, and we might potentially work with them in future. But again, the requirement would be that they give us a pref equity position, not a common equity position.
Yep.
Yeah. All right. So this last part, Rajan, which one is better?
Alrighty. So moving from a single asset to a fund, this is more of from a syndicator point of view. So one thing it allows us, like now we can continuously raise money. So you always have a deal that you can pitch to your investors. We have found that very useful. You can have a more meaningful conversation when you can basically sell them a deal or give them an investment. You know what kind of soft commits you have, or you can gauge the water. So putting in offers on deals is easier because you know, hey, I have, and this doesn't apply just to the income fund. Even if you have a generic fund, this applies there. You know that, hey, I have some kind of soft commits. My fund can raise this kind of money, so I can put in an offer. It's definitely cost and process effective. You pay once your syndication attorney, you pay once for the taxation, you get one K1 from the fund rather than multiple K1s. So things are easier once it is set up. Diversify the risk, like Pancham said. Uh, you might have like 4 or 5 deals which are really doing well, and one deal which is not doing bad. And in this business, one bad deal could be catastrophic. So if you have like 4 or 5 kind of really good deal and you have a one average deal, the returns look much smoother to your investors. Uh, the same thing, you are eliminating failure due to a single bad deal. If you have a large portfolio and your portfolio overall is doing better, and of course you smooth your distributions. If one deal is not performing well, your investors don't suddenly stop getting returns. So this is what we saw, like in our short career. Single asset syndications, if you are starting out, this is your first or a second syndication, it's always better to build a track record using a like using a deal, so people can underwrite that, people can understand your processes. It's very closed ended, so very easier to manage. Get the money, close the deal, operate, sell the deal, and return the money. It has a very clear start and end date and a very clear objective. Fund, on the other side, is more is becomes like more attractive when people have a track record. When people, like when your investors go in a fund, they are really giving you money. They don't have a ability to underwrite individual deals. Yes, you have the objectives of the fund. Yes, you have a design principle, but they really don't know what kind of deals would you be investing in. So the track record becomes very important. Fund gives you diversification. uh, like you have clear objectives now, that this is what we want to chase. Timing and experimentation are two virtuals, like the two virtues of a fund that you get. Like you are not entering a good deal at a bad time and then getting screwed because the market reverts. You are smoothing out your entry and exit point. And one really good thing we feel is a fund gives you room to experiment. If you know that your fund has like about 4 or 5 deals which are really blockbusters doing really good, and you want to experiment out a little bit outside your market, outside your asset class, fund is a place where you can basically take that little position and experiment, rather than doing a single syndication and blowing out your capital or confidence with your investors. That's our contact informations, email addresses, podcast, and basically a download to get more educated. So reach out to us if you want to.
So yeah, I guess Stefan, that was it for the presentation. Hope that gave people on the Zoom to the perspective of difference between a single asset syndication and the fund. We can take questions. I see some questions already on the
Yes.
chat. We can start by from the top.
Yeah, Pancham, that was really great. And Rajan, thank you as well. As always, introducing the fund that you guys have. And yeah, so we have a few questions in the chat. If you would like, I can relate those. So first question is, can you go through your construct of the single purpose LLC regarding to the terms between the limited partners, general partners? And where is the lender within the single purpose LLC?
So the second question is very simple. The single purpose LLC is just like this, right? When you buy your single family home, right? You take the title in your name and you get the mortgage. Where is the mortgage? Where is the lender? The lender actually puts a lien on your single family house, right? And you actually take the title to your single family house. So the lender actually, you owe lender the money and they have the lien on the property. They have nothing to do with the ownership of the property. So same thing here. Now replace yourself with a single purpose LLC. That single purpose LLC takes the title to the property and the lender actually puts a lien on the property, and they have nothing to do with the ownership of the property, unless you really do a bad job and they foreclose on you, and that's, yes, then you become the lender can potentially become the owner. So that's that. And then the first one is, I'm trying to understand the question regarding to the terms between, yeah, so okay, the terms between the limited partners and general partners, those are defined by the operating agreement that is prepared by the securities attorney. And also there is a ppm which details all the risk associated with the investment. But then there is an operating agreement which is prepared, which details out all the terms between the limited partners and the general partners. Hope that answers that question. And then
This
go ahead,
is
Rajan.
this is like, to add to that. This is no different than your any other GPLP LLC. So the fund is no different than the operating account of the LLC. Single purpose LLC versus the fund is no different at all. Everything is pretty much the same.
Mhm. And
Yeah.
then this question is kind of, I think it's a popular question, kind of private equity versus public equities, kind of fund versus REIT.
Yeah, so this is a good question, and we can try our best to explain that. Like, so you mentioned something private versus public. Yeah, so that depends on the how the fund is set up. A fund can also be a yeah, no, it's not publicly traded. Yeah, when you list it, that at that point it becomes the investment trust. Rajan, would you say that I'm hesitant to say that you cannot, like, all the REITs are listed and they cannot be private. I think there are private REITs also, but I have not seen a private fund. Sorry, a public fund that
Well,
is.
funds can be public, but they are
Yeah,
usually closed end. REITs
yeah,
are like real estate investments, but they trade. So I think the biggest difference, if we have to lay out, is the REIT is very liquid. You can trade it on the exchanges, and you can get in and out very easily. Liquidity works in both directions. The REIT directly doesn't tie out into the value of the real estate. You have market factors that impact its value. The second biggest problem, or a biggest difference, is most of the money that the REITs distribute goes as dividends. So the
exactly.
taxation is very, very different on the money that the REIT distributes to the holders versus a syndication or a private fund, most of the money here is treated like distributions along with capital gains at the end. So I think that that's one big difference. And again, like I've seen like funds that buy REITs internally, but I think like those two would be the biggest differences. That one, you get much more liquidity as they are trading, and the treatment of the income that they distribute to people.
Yeah, and give an example of last year March when the coronavirus came and the market tanked. The REITs went way low in their value, even though the properties may not have gone that bad in terms of the performance. So they actually are sometimes disjoint in terms of how they perform. Yeah, and in case of a private fund, we it depends on how the fund is set up, but there are funds where they have this objective of they are going to get the NAV, which is the net asset value, every quarter or every 6 months or every year. And that would be in the objective of the fund, where you will get to know, okay, how much this value of this fund is, at that point in time. Yeah, I hope that answers the question.
I mean, if I may add, Pancham, actually the residential REITs drop was even like, let's say ETF REZ was over 20% down, which is only residential and not commercial. And so the expectation, I've seen pension fund studies, the expectation being of like a 91% correlation and the two to move together, but kind of lagging, and maybe half the drop in the private space. So kind of maybe half of the public reaction and slowed down, maybe like 6-9 months later. But then we didn't see it. I don't know. It's strange. So yeah, you're right. Basically, there is they can be a bit disjoint at times, and a more pronounced reaction in the public markets.
Yeah, yeah. All right, we can go to the next question here. How are K1s distributed each year with the fund? Multiple K1s or not? So, good question there. So there is a fund level K1, and then for each state where the property is, potentially you will get a K1 from that state. So let's say you have in property in North Carolina, South Carolina, Florida, doesn't matter because there's no state level. Yeah, so you will get two K1s, one from NC state and one from SC. In that case, uh, I hope that answers that question. Uh, Next question: do the GP invest in the fund alongside the LPs? Yes. So I guess this is a general question. We can answer it for our fund, but generally speaking, that really depends on the objective of the fund. You can actually see sometimes it's not even in the objective. You have to, just like you're asking this question to us, let's say for our fund, you would have to ask that question directly to the fund manager to really get an idea there. And to answer this question for us, yes, we invest in every single one of our deals alongside our investors. So yeah, we are investing in the fund. Okay, so the next question, the better here is from GP's point of view. What about LP's point of view? I assume you're talking of the fund. From LP's point of view, like I discussed on the slides, I can go back, is really, if you think about it, they get that diversification, right? They get here, right here. Oops. Yeah, this one. They get all of this over here on the left side that they get from the fund, right? They get the diversification across asset classes. They get it across geographies, strategy, timing, simple reporting, smoother distributions, right? There's no less up and down, right? So I hope that answers that question. So is the choice available to passive investors is to invest in the fund and thereby invest in the pref equity position of multiple deals, or to invest directly in the individual deals as LP in the equity position? If yes, what are the terms for the latter? Yeah, the first question, if I read it right, and I'm going to rephrase it for the audience, they basically, you're asking that the choice for, as a passive investor, you have a choice to invest directly in the deal as a common equity position, which we call Class B shares for our deals. You can name it whatever, but for us, we call that Class B. You have to directly invest in the deal, or you invest in the fund to get the pref equity position. So the answer to that is yes, but we also have a Class A shares in the deal where people can directly invest in if they choose to, but they don't get diversification. They will still get the pref equity position, but most of our investors invest in the fund, and the fund actually buys the Class A shares. So we have Class A, which is the pref equity, and we have Class B, which is the common equity. So your question is, what are the terms for the latter? We can quickly go over the terms on the Class B that we have typically for our deals. They can vary really from syndicator to syndicator. We would need another more time to go over all the details, but yeah, it's basically a 70-30 split, like Rajan was explaining in the fund, and we give out 7% preferred returns to the investors, and it's 70-30 split. um, Hope that answers that question, Jagdish. And then we have Brian, with this question: how many properties are acquired with the fund? How quickly are the properties purchased? How long does the money sit idle in the fund until the property is purchased? So that's a great question. So Brian, what we do is we actually do not raise capital into the fund until we have the deal. So your capital doesn't sit idle forever. It does sit idle for, let's say, a month maybe at the most, when we start raising the capital. I'll give you a live example of this. We are actually, as of this week, we just started raising capital for a deal which is closing on 15th of September, tentatively speaking. And today is August 16th. So people who start wiring money today, their money would sit idle for 30 days, and they won't make any return on those 30 days. And we have put that in the fund objectives. So, to so yeah, that's so their money will sit idle for a month or so, but not more than that. And how quickly the properties are purchased? As soon as we find them. We are it's very, very relative. You will see people who are doing a lot of deals every month. We typically do 3 to 4 deals a year. This year we set the goal to do even more. We are set to close 3 deals at least already this year, and potentially 2 more, so 5 this year potentially. And in the first, how many properties are acquired with the fund? There is no limit on the property count. It's really on the size of the fund, which is 10 million. So
if I may add, Pancham, to this question, just the mechanics of, I think maybe the question a little bit points to the mechanics of, okay, you have a $10 million fund, and then you'll be acquiring like let's say 3 to 5 deals per year, and then it will be kind of with a certain time lag between them. So the 10 million quote unquote fund, is it soft commitments initially, I assume, and then once or hard ones? And like how, so this kind of lag, like how does it affect the returns, the fact that you invest in a deal and then you wait and then you invest in the other one, and basically at inception, like once you have already accumulated a set of, or at inception invest, you have like, yeah, I mean, it's just like basically once you accumulate a set of, let's say, sufficient number of properties to cover the the capital of the fund, then you can kind of be replenishing it easier, but initially it kind of needs to build up to there. So how does this dynamic work?
yeah, sure. So yeah, you're asking, yeah, so the thing is that this is a pref equity fund. It's only, like we said, we only invest 15% in the overall property. So the properties that we are buying right now, the one that is closing on September 15th, it's a it's approximately $18 million property, and we are doing only $1 million through this through Class A, right? So and you can extrapolate that over 10 properties, and let's say 1 million each, we can buy up to 10 properties. And then for each and every property, we will have capital events lined up. For example, the property that we closed in February, we invested 1.7 million from this fund, and we are potentially refinancing or selling that property next year. We already achieved the business plan, and what's going to happen is that when we refinance that property, the money is going to come back into the fund, and we would, at that point, investors will have an option. If they want to get their capital back, they can get it back, or we will have that funds available there to invest in other properties. I hope that makes sense.
Steve, to answer our color, I think we don't need to get to 10 million to start the returns. So the whole idea is like when you the size of the fund is the upper limit on the fund. So we start raising by 1 million, and then as soon as we close the deal, those millions start getting their 8%. Then let's say after 6 months, we identify another property and we underwrite the deal with another $1 million of this income fund. Then we're going to raise million more. And then this new property also gives out pref. The old people are already getting their 8%. The new people start getting their 8% after this deal closes. So we don't have to get to 10 million to start the distributions. We start the distributions as soon as you get in, and a property is bought after you get in. So your money, like we answered earlier, is sitting idle from the point you got in to the point the first property is bought after you got in. uh, the fund makes a higher pref than 8%. We pay out like typically 9% from the deal to the fund, and that extra 1% basically potentially would help us to cover up any idle periods or any fund expenses and stuff like that.
So Rajan, so just to confirm, like from my understanding, so you have, after all, it's not a 10 million upfront capital raise of hard commitments. It's more like you're kind of targeting, maybe you have it in a soft commitment space, and you kind of then you raise it gradually over time, is what you're saying.
Yes, we don't even need to have soft commitments. That's just the size of the fund. So basically we can raise money anytime we need, but
it's just the legal definition of the legal
exactly.
size definition of the fund.
Exactly. So the 10 million number is completely like a legal aspect or a virtual thing, just to keep the fund limited. But you don't need any soft commits, hard commits, or anything. You raise what you think you can pay out 8% on.
Okay, understood. So yeah, the next question from Brian. Can you talk about how you're able to manage and or oversee the rehabs on multiple properties at the same time?
So we have like we have a game plan, or we have a capex plan and a value add plan when we buy any property. We have a third party property manager. We have a team that helps us. So at the end of the day, it is a process and a function of what you are underwriting and what your capabilities and your plan is. So it's not that we don't like per se both of us or our team execute the whole plan. We have a property manager, third party, which is very strong in the markets that we buy in. Then we have other people who help in these construction, overseeing of financials, overseeing of value add plan. So at the end, it just becomes a process and the plan that needs to follow. So this is not a function of the bandwidth on time. This is a function more of what the plan is and what the teams are.
If I may come back still to the previous kind of timing question, because let's say, how do you achieve the diversification in the sense of like in the pure mechanics of, okay, if once you have the first deal, people are investing in the first deal, and to your point, funds don't stay idle, like it's like at most a month or, or so forth. And they're invested in that deal, then maybe a refinance happens, also a new property gets purchased. So the people who invested at the time in the fund at the time of the first deal, they will be in the first, second, and onwards. Is that so? And then the ones who invested later will be in the second and onwards, and in the third and onwards, and this kind of shifted sequences, or how?
So basically, yes and no. They are in these shifted sequences only in the distributions they are getting. But let's say, for example, I have a fund for $200,000. I open the fund at the first deal. I need 50,000. You invested. Your 8% would start right away. And your exposure is only to that deal. After 6 months, I need another 50,000 and Pancham invests. Your distributions are going on, but Pancham's distribution will only start when he invested. But your and Pancham's exposure to both the deals will be 50% each. So although you put your money when I was buying deal number one, and Pancham put his money when I was buying deal number two, both of you have equal exposure to the deals.
Okay, understood. Yeah, that's understood. So essentially, your diversification will kind of increasing over time.
Yes.
Sounds like
yes.
The scope of the fund will be changing, and you constantly get the returns of that fund, which could be one deal at the beginning, 2 deals, 10 deals forward, etc.
Yes.
Okay, that I understand.
This fund is very simple because it's taking a very small pref equity tranche. Valuing the fund is simple. Risk is very minimized. So the diversification component and everything doesn't come into play. But just extrapolate the fund and think that you're buying common equity from this fund. Then that component really kicks in because you could lose your capital, you could have a blockbuster deal, you could have a bad deal. So the diversification really, really becomes very important. This fund is more of a high yielding bank account. The only thing we need to track is when you come in, when you leave. So your 8% is tracked, and just make sure that we are not taking super aggressive bets on random assets and not going above 15 to 20% of the equity stack. I think as long as those design principles are met, your capital and your distributions are very much in line. So the key diversification component does not really get exploited in this fund. It would get exploited a lot when you have a real common equity fund.
Yeah, that is a good clarification there. Yeah. So next question from Rafael: how will distributions reporting be handled?
You get a K1 at the end of the year. So the distributions will be reported there. If the question pertains to like the tax treatment of these distributions, I mean, that's more of a CPA question. What we can answer is that the fund does not get any depreciation. So basically, these would be treated like a common equity, a common ordinary
Dividend.
some kind of a thing. But you would get a K1 where these will be reported.
And we actually send out monthly updates on this,
Oh,
yeah. So we send out monthly distributions though, so they get into your ACH'd into your account every month.
Let's say if you guys can come back, if it's okay, you had like the part where you showed like different asset classes that you could potentially invest with in your deals, and then respectively the pref equity kind of for the fund where you had like the mobile, manufactured homes, etc. And I would just wanted to get to that part, if okay. I'm not sure if you have it on if you can return the slides to there.
Sure. Oh, I think.
Oh, no, it's okay. So I was just curious. Yeah, I was just curious if you have, like, when you mentioned that, like for you guys specifically, like, do you have different targets? Like, you mentioned some of the objectives of the fund, but now at the deal level, for the common equity investors, let's say, like, what do you have like different targets in the case of value-add multifamily versus, I mean, I assume versus mobile home parks in terms of cash on cash and IRR? Or you don't, or it's kind of more deal.
So we don't do anything other than basically point number one. So Mesos, we specifically target.
That was not for that was just the general discussion.
Yeah. So for our value add so to answer you, we raise common equity only in point number one. We are not raising common equity in mobile home parks or anything.
Yeah, that's
point number one. Our targets are like we chase value add products 85 to let's say 2007. We want to pick up deals where the investors are organically getting their pref from let's say Q2. If not Q1, we want to get that target sooner. We don't like to raise money for distributions or not pay out distributions. And at the back end, we project about a 13 to 15 IRR. So we chase deals where we believe we can give the common equity guy somewhere between 13 to 15 IRR with a 6 to 7% annual return.
In what kind of holding period? Typically like 5 years or?
Well, we have been projecting 3 to 5 years. The way the markets are moving, we are exiting or refinancing some assets faster than what we are projecting. So our hold periods in the last 3, 4 years have been shorter. But yes, we do underwrite most of our deals on a 5 year hold period.
Right. But then your realized IRRs have been, sounds like quite higher, right?
Yes.
With the shorter exits. So it
Yes.
seems that like really drives IRR.
So that is true. We exited 2 deals. So far, our realized IRRs were like about 28 and 27%. We are exiting 1 deal right now. Actually, tomorrow is the call for offers. We are projecting a way higher, even way higher IRR than 30%. So we don't know. We don't know the exact number right now, but it's potentially going to be over a 50% IRR deal. So that was also underwritten at a 5 year mark, but we are exiting at 3.5 years.
Wait, so that one is, you're saying projected is 30 or the realized one was?
No, so the projected was about 14. The realized is going to be more than 50.
More than 50, 50. Wow, that's great.
But hey, past performance is not a projection of
Yeah.
future. So that was a good deal. Yeah. So we are.
And that was what kind of holding period? Like 2 years or so?
3.5 years.
3.5 years.
3.5. That's great. Wow. And then, yeah, so we have actually a couple more questions in the chat. If you would be kind enough, we're a bit over time. And thank you so much actually for, for joining us today and, sharing your time as well. We have a question from Svetlana.
Yeah, I can read that. So can you talk more about your track record in real estate before starting the fund? How many deals you had closed before you decided to start a fund? Thank you. I missed the beginning of the presentation and I apologize if those questions were already answered. Actually, no. And that's a good question because one of the key things when you start a fund is you have a strong investor base who's like willing to invest in you rather than deals. So yeah, so we had closed 2 deals completely, like sold those out. We had done one large refi where we returned about 90% of the capital. And we had done about 6 syndications before we started the fund. So we had like not a huge track record, but somewhat like a beginner to somewhat like somebody who knows what a syndication is. We have proved out 2 deals, 1 refi and stuff like that. Cost seg and bonus depreciation, how does this work in a fund? How much of the 50% IRR end up in the LP's pocket? I assume the first question is generic for a fund. So no cost segregation and bonus depreciation comes in our fund. Our fund does not take equity. It's a pref component. So there is no depreciation at all. But I assume if you have a common equity fund, the cost again, the bonus depreciation would flow in the similar proportion as the equity. And I believe your second question is to the deal we mentioned. Whenever we mention IRRs, we mention about LP IRRs. So in all our projection, in all our deal packets or anything, when we say, hey, there was a 50 IRR project, it means a LP 50 IRR. So
yeah, the project IRR is much higher actually.
Yeah, the project IRR is going to be much higher. We believe the LP IRR is going to be north of 50%.
So, and just to translate, I don't know, at least for myself. So let's say, since it's a 3.5 year period and the project IRR was higher, so what was let's say the appraisal raise, like percentage wise?
Yeah, so it's a 4x multiple approximately for this deal. So if someone invested 100K, they get 400K back.
No, not on a levered basis, just on an unlevered, like the purchase.
So we went in at 4.6. So we went in at 4.6. Yes. Those were the days you could buy something for 4.6, and we anticipate we'll get a offer above 11. Okay. So we don't have the actual numbers, and we might be off by 500K here or there, but our BOVs were coming around 10.5 to 11.5. So technically about like 2.7%, 2.7 times of the total unlevered appreciation.
Which market was that in, if I may ask? Like
this was Charlotte.
With Charlotte, okay. And that was it like a more significant value add, or it was relatively stabilized the property condition, or
Uh,
it's
it was
sort of an
both.
occupancy,
Like
let's say.
it was both. We
Uh-huh.
went in with the NOI of about like 340,000. Cap
Uh-huh.
rates were higher those days, so you would still underwrite deals at 6.5, 6 cap. We took the NOI from like 320, 330 to about 470, 480. So that was steep in 3 year period, that we almost increased the NO by 40 to 50%, and the
But
cap rate.
that was a 90% plus occupied property before. It wasn't like a
Yes,
big
yes.
value
So
add. That was a
it was not a property
yeah.
that was distressed or anything. It was 90% plus occupied.
You
Late
just had
90s.
room to raise the rents, and there was
Yes,
some
so we went in.
rent growth in the period as well.
Yeah, so we went in, we raised the
Uh-huh.
rents, we did some value adds like water submetering and all those things.
Mhm.
So yeah, but we did not do things like changing the tenant class or bringing units online. The property was very stable when we bought, running above 90%.
Did you have mm, like a mild renovation budget or a medium renovation budget, or it
We
was
had we
it
had
was
a
more
we
on
had,
the
a- we
income
had a
side?
mild to medium renovation
Mild to
budget.
medium. Uh-huh.
Yes.
Okay, got it.
So we
Got it.
raised
That's
about
great.
we raised about, I believe, like I don't have the numbers in front of me, about 350, $400,000 for renovations.
Mhm.
But that's what we have seen in most of the Sun Belt, as they call it, the stronger Carolina markets, stronger Atlanta market, North Florida. Those are the markets we are in. That rent growth has been pretty robust for the last 3, 4 years. So we've been raising rents like
But
pretty
it,
aggressively. Yeah.
mhm. And also when entering, let's say time zero, rents were, would you say they were just below market by like 20% or 30, something like that? Or it sounds like,
I
or
would not say they were crazy below market.
uh,
It's just the rent growth in those markets is definitely higher.
was high.
So we like, actually, if we have to say that, for our other deals in the Carolinas, this property saw the minimum rent increases. We have other properties in Raleigh and Wilmington where the rent growth is way more explosive than this property.
I mean, to give you an example, like our latest acquisition, which was in February of 2021, 8 months ago now, right? Sorry, yeah. So 6 months actually
Yes.
when we went under contract, right? So it's when we projected the numbers, we projected about 8 months ago, and our projections were to achieve certain rents in 5 years from that time. It's August of 2021, and we have already achieved those rents, and we are still the lowest in the market. We just got the market survey done on that property last week. We have already achieved our business plan of 5 years in 8 months, and we got the rents to where we wanted them to be in 5 years and 8 months. So you can imagine the rent growth on the property that we are selling is actually the least out of all the properties we have had in Carolinas.
Oh, wow. And that's what percentage, annual percentage roughly, let's say you've seen in your market of rent growth?
So most of the so this like the two assets like we acquired in the last 1 year, one we are able to raise rents about 20-25%, the second one about like 15. And this is without renovating
But,
anything
Rajan,
immediately,
just so
just
that,
property turns.
and I know we're over time, but just kind of like I think in very high level terms. So let's say you raise the rents 25%, you on the deal where you more than double the appraisal, if we use this as an example, right? I would expect you raise the gross income by, maybe 50%, and then you have a 50% expense ratio, and then you kind of double the NOI, right? Let's say, but you're saying the rent growth was 25%. So what was the rest,
Oh, I'm
or
saying
the
I'm
market
saying
rent growth?
well, there was water submetering income that came in.
Mhm. Then
So
the cap rate
and the
suppression.
cap rates helped, right?
Yeah, yeah,
Like 3 years
mhm,
ago, we were underwriting deals at, like, when we got into this deal, I think it was
yeah.
north of 6. The exit is at like south of 5. So
Mhm.
definitely the cap rates in the last 3, 4 years really helped. So that's why we always say that, hey, uh, we can say that what we can do, we really don't know how the markets would behave, and definitely don't know how the cap rates would behave. But last 3-4 years, cap rates has been a major contributing factor to these explosive LP returns and stuff like that.
Yeah, and Stefan, like to answer your question, like yeah, the NOI would be double and all that. What we are talking about here is on the units that we have already turned. So we have not 100% turned the property. Like for example, the one that we bought in February, it's been 8 months, 6 months. We have not turned the 100% of the property. We've turned, let's say, 25% of the property. On those 25% of the units, not 25, not even 25, I would say 15% turned and 10% renewed. And we are able to achieve those rents.
Okay, got it. Okay, do you guys have any last question maybe before we wrap up for today? Okay, so just like make sure to reach to Pancham and Rajan at the emails that they are sharing here, pancham.gupta@misoscapital.com, rajan.gupta, and you guys are not related, I believe, right? Yeah.
No, we are
No,
not related. We have the same last name, but we are not related. Yeah.
Yep. At misoscapital.com. Their podcast, the goatcoreinvestor.com, and download the top 6 reasons to diversify outside of Wall Street at the goatcoreinvestor.com/download. With that, thank you guys for really sharing this great information with us today. I really appreciate it, taking the time and joining us here. Thank you so much. And thanks to everyone for joining.
Thank you, Stefan. Thanks, everyone. Bye.
Thank you.